All right. Welcome, Cynthia, and welcome to everybody in Finance 333. This is your last and final session for the mod, which means that if you're caught up with your work at this point, all you have left is the final exam and a career integration quiz, which is only 15 points and just some real basic feedback. As long as you give some kind of opinion that shows that you put a little bit of effort into it, we'll give you full credit for that career integration 15-point quiz just to help the course for future students. But the final is worth almost two or just over 2 letter grades of your overall score in the class. So not to stress you out, those of you who have anxiety already about test taking, I don't say that to stress you out. What I do say it for is for those of us who sometimes procrastinate, for those of us who sometimes don't study as much as we should for important tests, I would strongly encourage you to take a few notes from the session, and as far as the topics that'll be covered, and then make sure that you've read and reread over notes and material that we've had in the class so far. All the test material in this class has been taken straight from the textbook, the ebook. So instead of going back through and trying to read extra articles, that we had on the readings and tools each week, I wouldn't spend any time with that as I prepared if I was preparing for this final test. I would only spend time in the ebook looking over the topics that you get tonight from the session, where I tell you exactly what will be on the test as far as the topics covered. Okay, so I'd take those notes, I'd read through the parts about those different topics, and then I would feel comfortable and confident that you'll do fine. Formatting, again, is true, false, and multiple choice. 38 questions, if I'm not mistaken, so almost 40 questions on the test. And again, over 2 letter grades worth of your overall score in the class. All right, so enough about that. That's just a little preview. Tonight, we've got a couple main objectives. One is to cover Chapter 15. We'll cover some of Chapter 15. You've only got one chapter this week on commodities and futures. And then, and perhaps more importantly, we will spend a good amount of time tonight, probably 25-30 minutes, talking about the topics that you need to know for the final exam. Okay, the final exam is comprehensive. It goes from Chapter 9 through Chapter 15, which are the chapters that we've covered so far in the course. So you'll want to make the ebook your friend and get familiar with those topics that we tell you will be on the test tonight. All right, so with that being said, those are the only 2 objectives we have tonight. But before we get started, Cynthia, because you're here, I appreciate you being here. Any specific questions about the coursework up to this point, about anything that you would like us to look at or cover for a few minutes before we get started? And while you're thinking, Cynthia, just a shout out to any of you who are in Texas or have loved ones there. They're dealing with a horrible situation, and I just wish the best for you and any loved ones that you may have in that area. It's a really bad deal, much worse, I think, than anybody expected, and some mixed messages as far as whether or not people were supposed to leave their homes and neighborhoods. And so a lot of people stranded in a bad situation as far as travel and their housing down south. So send love to anybody who's down in that area. Check in on relatives and family if they are down there. And yeah, that'll be good. All right, Cynthia, you did come up with a question curious on the math for the assignment. I got some help from the Success Center, so I was curious what I did wrong. But no worries. Are we talking about the math from week 2, I assume? Oh, from week 3. Okay. Haven't gone over that yet because I haven't graded all the assignments for week 3, but I'd be happy to give you some feedback on that once I get to them. Sorry. Anything from weeks 1 or weeks 2 as far as specifics? Anything that we can cover? You'll have feedback by tomorrow, Cynthia, on the assignment. Brad, good question. Anybody who needs my email, it is david.shipley@stevenshenager.edu. It's also, if you go into the inbox on the left side and you're always able to do the drop down in the to box to the instructor. So that's another way you can email. Another way you can email me or find my information is in the course syllabus or the course information page. So there's the main course page, and if you go into the course information or course syllabus, they both have my phone number and my email, as well as the session one, or the week one session, where I gave out the email as well. So lots of different places you can find my email, but good question. I have had a few people ask. You've got lots of access points to get to my email. And Brad, another good question of that, I posted a few announcements to this end, and that is that many of you are struggling, or for whatever reason, your computer formatting will not allow you to resubmit anything or even submit anything late. You're welcome, and this is a good reminder to just email that to me as an attachment. And now you've got it, david.shipley@stevenshenniger.edu. Okay? And thanks for joining, Brad. Appreciate it. As far as all the grading to this point, some of the grading's been done, but we'll go ahead and complete all that out by tomorrow, as usual. And so you should have a very good idea of where you're at. I mentioned earlier that the final is worth a couple letter grades. Over 200 points of a 1,000-point class is on this final exam, and so I just strongly encourage you to do what you can to prepare for it, to give yourself plenty of time to relax, and the way that you can better relax for a test, which some people can do this better than others, but the way you can really relax for a test and be calm and confident is to put in a good amount of study. Right? Tends to raise our anxiety if we don't have enough time to take the test and really put forth the right amount of time, and if we haven't studied very well. Okay, those two things can add to the angst and anxiety around a final test. All right, real quick, just a quick reminder that all work, late or otherwise, can be turned in up until this Saturday at midnight. Once we get past Saturday at midnight, there are no extensions beyond that point. So again, and I've already posted this on the announcement board, but sometimes I realize that's not something everybody looks at. If you find yourself behind at this point, happen to be listening to this and determining, should I continue or should I just give up on this course because I feel like I'm too far behind, I am always going to cheerlead all the way until the end of this week, all the way until Saturday at midnight, for you to put in whatever effort you possibly can to try to pass the class. I think it's a horrible waste of a class to participate at any level, even if it's just paying for the course, right? Because it's a significant cost, and then not be able to, complete the course. And it's only Monday. You have got plenty of time to get caught up, no matter how far behind you are at this point. And I would strongly encourage you to do whatever you possibly can to pass the class. Remember, the difference between somebody who passes the class and doesn't, in my experience over the last 6 years, and at this point I've probably taught over 100 classes, 100 different courses. Key difference between people who pass and don't is just getting their work in, right? So whatever it takes this week, be completely dedicated. If you find yourself behind at this point, to make sure that you get all your work in, and you'll be great. Brad, I completely agree. These courses go by very quickly. And if you've got children with school starting again, kind of wrapping up the summer months, it just seems like things go so fast, when we get into a course like this. So I know that there are a handful of you, and I don't think, Brad, Cynthia, I think you guys are pretty well caught up, but I know that there are some people who are going to be listening to this that are going to be trying to determine whether or not they should even finish the course. And I just strongly encourage you to obviously it's going to take a lot of effort and diligence, but you can absolutely get it done. And it's well worth it to just pass this class so you don't have to see it again going forward, and move on, make some progress, jump through the hoop, get on to the next thing. All right, Cynthia, Brad, without any other questions, we'll go ahead and jump into commodities and financial futures. First of all, one of the things I wanted to talk about, just as kind of a basic overview with commodities and financial futures, is that the whole reason that futures, commodities, and financial futures exist, and the whole reason that options exist, which is the topic, one of the chapter topics that we covered last week, the whole reason any of these exist is because at some point these products were created, these derivatives were created in order to hedge a situation. Okay, and we talked, the assignment last week, should he hedge or should he not, was kind of a whole approach to whether or not hedging would be a good idea in this particular circumstance, the circumstance of the case study last week. When it comes to commodities, when we talk about agricultural commodities, for example, soybeans or corn or wheat or barley, when we talk about those different agricultural commodities, the whole reason those derivative products or futures products exist is because at some point there was a farmer that said, I am raising corn, and depending on how the year goes, my price could be very high or my price could be very low. Instead of having the unknown, I want some predictability about my season, right? Because when you go to plant corn, you've got about a 4-month or 4.5 month, time from planting, from seed to harvest. And the price of corn between that time could change pretty dramatically, right? You could go from making a lot of money to losing a lot of money when it comes to farming. So somebody very smart, probably a farmer, just said, hey, there's got to be a way, if I pay a premium, if I pay a fee for it, that somebody should be able to guarantee me a price. Okay. So instead of not knowing what I was going to get at the end of my season, I can actually pre-plan and know exactly what I'm going to get at the end of the season. And yes, it costs money, and yes, there's the potential that I might not get the upside if the price were to go way up, but I won't have to worry about the price potentially going down and potentially losing a lot of money. Okay? So that's a little bit oversimplified, the explanation I just gave, but that is the reason why commodities and financial futures exist, is because for farming, it made sense for these different products, especially the agricultural ones, obviously, to hedge or to protect the price that the farmer was hoping to get at the end of the season. And for a fee or for a premium, another party is willing to do that. Now, if the price goes up, the other party benefits from that. Not only do they get the premium, but they get that higher, the price difference, right? The flip side is if the price goes way down, the person who entered that contract with the farmer might lose some money, right? If the price goes down beyond what they made in premium. Okay. Now, does that all, I know that's probably clear as mud, but I wanted to make sure before we get started with these products, a lot of people, we get into these products and they're like, why does this even matter? I'm never going to buy futures contracts. I'm never going to speculate with this stuff. But one of the things that keeps financial markets more stable is actually the fact that there are all these different contracts that are trying to protect pricing. Okay. If I'm Apple and I make iPhones, and let's say one of the key components of the iPhone is some platinum. Let's say there's some platinum chips inside the phone, and so I have to pay a lot of money each year as Apple to pay for platinum, right? That goes into my iPhones. I make millions of iPhones, and I want to make sure that my platinum price stays consistent, because if it goes wildly up and down, I'm not going to be able to predict how much my profit's going to be, and in turn, I'm not going to be able to know where I should price my phones, right? Well, as you know, these companies like Apple enter arrangements and guarantee pricing way in advance of even having those products released. So how would they protect themselves from the price of the different inputs inside of the phone going up and down? So again, back to my oversimplified example, I don't even know if iPhones use platinum. I'm just making this up, right? If iPhones use a lot of platinum, Apple could go out and lock the price of platinum through a futures contract, okay, and insure themselves a certain price over the next year for platinum, for all the platinum they use in their cell phones. And they could do this by paying a premium to another party that's willing to enter that agreement. Now, if nobody else is willing to enter that agreement, then they can't do it. But there's always somebody willing to enter every single futures agreement at a certain price, right? So we may have to up our premium or up our price in order to get somebody to accept our arrangement, but somebody's always going to be willing to do it at some price. And if we're not finding a counterparty to our futures agreement, it probably means that our pricing isn't set right, right? We probably need to offer more premium in order to make that contract go. All right. Brad, don't worry about it. You're not going to get docked late for having something a minute late in this class, so don't even worry about it. Any questions on how farmers or even how Apple could use futures contracts to hedge their pricing or to protect the pricing of something that they use? Another quick example, if I made bread, right? Key ingredient to bread is flour, right? Key ingredient to flour is wheat, right? And wheat prices go up and down. Well, I don't know if you've noticed recently, but bread pricing through the average grocery store stays pretty consistent, right? So every once in a while, bread goes up by a little bit, but most of the time, bread pricing stays pretty consistent. And that's because the grocery stores want to work with a manufacturer of bread that will keep their pricing fairly stable. But what happens if wheat prices are jumping all over the place? That means that whoever's manufacturing the bread is going to have a hard time with their profit margins. They're not going to know from week to week or month to month where their profit's going to be, which is unacceptable for most companies. Most companies want predictability, right? They want to be able to analyze and predict where their profits are going to be. So in the case of a bread maker, they could go out and buy futures contracts on wheat in order to lock, in essence, their pricing of that key input that they use for flour in their bread. Okay. Then if the price of wheat went up and down over the next 6 or 12 months after they'd locked in that futures contract, they don't care, right? They know exactly how much they're going to pay because somebody else agreed to deliver wheat at that price for a premium, okay, for some kind of cost. All right, so we've given you a couple different examples on how this works, but let's get into some of the slides, and I think it'll add some color to what we're talking about. We're not going to talk about learning goals, we never do, but when we talk about the futures market, we're talking about a different kind of market than the cash market. The cash market is where goods and services are exchanged that day, right, with cash. The futures market is a market where goods and services are not exchanged that day. There is a contract. We enter a contract to exchange goods and services at some point in the future. That's why it's called a futures contract, because we're agreeing to terms that will take place at some point in the future. Okay? All right. Now, what's a key difference between futures contracts and options contracts? Just as a side note, and it probably says it here in the slides here in a minute. We talked about options last week, and a key difference between options contracts and futures contracts is futures contracts are a contract that cannot be broken. Options contracts are the option to enter the contract, right? So very, very different. Now, same concept. They're both derivatives of another financial product or another product, but futures contracts, you actually have to deliver the product at some point. So what if you can't deliver? Well, then you got to go out and buy the product from somebody else in order to deliver it. So if I'm a corn farmer and I have locked my future price with a buyer and then my crop gets destroyed, I have to go out and buy corn from somebody else in order to fulfill that futures contract because it's an absolute contract, okay? It's not an option to do it. It's an absolute guarantee that we will deliver, okay? All right, here's some different examples. Corn, wheat, cattle, lean hogs, right? Interesting. Coffee, cotton, gold, copper, oil. You can buy futures on oil in the future. You can buy currencies like the yen or the pound or the euro. You can buy futures on treasury bonds. You can buy futures on the market, the S&P 500. Okay, so those are different examples, and keep in mind these are going back to 2012, but these are different contracts that you could enter in the futures market. Okay, so a single contract for 50,000 pounds of feeder cattle is $70,000, $70,750. Okay, for 100 troy ounces back in 2012, it would have cost me $161,010. Okay, but that would lock my price, right, for delivery on that gold. So if I'm a miner and I'm worried about the price of whatever I'm mining, gold, silver, whatever it is, going down, I can enter into a futures contract to accept a certain price in the future. Another quick example is the airlines. The most cost-intensive thing that airlines use is fuel, right? They fly us all over. The most cost-intensive thing that airlines use is fuel. But the price of oil goes up and down quite a bit, right? Well, this causes a lot of problems for airlines. When the price of oil is down, they make great money. When the price of oil is up, they can go out of business and go bankrupt. In fact, Delta Airlines has gone bankrupt twice in its history due to high fuel costs and the fact that they lost so much money they had to declare bankruptcy a couple different times in their history. Okay, and they're still going strong now at this point, making all kinds of money because the price of oil is low. But one thing that airlines can do is they can go out in the futures market and actually hedge or buy futures contracts for oil so that they lock their pricing and have some protection when it comes to the price of oil, their key input to the product that they're offering. Okay? All right. Are you starting to get some ideas, Cynthia and Brad, as far as the wide range of different ways that different companies and farmers can use futures contracts to help protect themselves? Good. Now, of course, farmers and companies are the reason that the futures market and options markets exist, for hedging. But what ends up happening in the real market today when it comes to futures and options? Well, a lot more people are what you're referring to, Brad, and that is a lot more people start to speculate. So what if I don't have a company, I don't use oil at all, okay, but I decide that I think that the oil price will go up over the next, year, okay? Well, I've got a couple different things I could do. I could buy barrels of oil and store them, which would be very costly to store oil, right? Especially for me, since I don't consume any oil, I don't use it. So that's one way I could invest in oil. Another way I could invest in oil is buy options, the option to buy at some point in the future, and that would be a good way if I was just speculating. But I could also buy futures contracts on oil and actually lock an oil price that I think is a good deal in the future because I expect oil to go up. Okay, so I could use options, I could use futures, or I could use the actual commodity itself and just buy the commodity and put it and store it. Okay, which is not really reasonable for most of us to store any of this stuff because there's so much of it, right, in one contract. I can't really store 50,000 pounds of cotton at my house, right? So that's why using options or futures contracts makes more sense if I'm trying to speculate. The problem is, Brad, when it comes to speculating, I have to guess which direction I think whatever it is that I'm investing in is going to go. And when it comes to commodities, even more so than stocks sometimes, they can be very volatile and they can become very unpredictable. So if there's a storm in Texas like there is right now, the price of oil is going up significantly right now. Okay, over the next day or two, you'll see it even go up more because a bunch of refineries in Texas are shutting down. This creates lower supply and an increased demand situation, so pricing goes up. But if you were to have asked me 1 month ago, what do I think the price of oil is going to do? No one would have been talking about Hurricane Harvey. No one knew about it. No one knew it was going to be this big. No one knew that it would shut down the refineries and shut down oil exploration and production down in Texas. Okay? So if you guessed that oil would be higher, then you guessed right. And because of Hurricane Harvey, you would have done quite well. But again, you would have been guessing, right? So there's some unknown and unpredictability to what we're doing here. There's also some other risks that I think some of the slides actually talk about. Characteristics, you've got a future date, contract, it's binding. All trading is done on a margin basis. That's that final point, which means that you're borrowing money to accomplish these contracts. So why do people use it as a speculative product? Because there's a potential for very high returns because you're buying on margin. Margin always exponentially increases the potential for returns. It also can exponentially increase the likelihood, or excuse me, the extent of your losses. Okay? So you can magnify your total return, but you can also magnify your total loss, even beyond the money that you invested in the product itself. A lot of times these are cashless transactions. They're just future obligations, right? Okay. So high risk of losing more than the amount we originally invested, no limit to exposure on the loss. Everybody see the slide that we're on, disadvantages of using future contracts? We see that okay, Cynthia and Brad? So Brad, one real quick point to your point about seeming really speculative. I would submit that a farmer using futures to lock in a futures price, or an airline company locking in a future price of oil, or a mining company locking in a future price of whatever they're mining, or a rancher, I mean, there's all kinds of applications to futures contracts that I don't think are speculative at all. In fact, if anything, they're prudent, and they're a smart thing to consider to protect yourself, right, from the risk of a downturn in whatever product you're using or producing. However, if you're just going out and have no real exposure to any of those things and are just going out to try to guess which direction one of these products might go, I think that's highly speculative, right? Even more so than investing in the stock market. A lot of people look at the stock market as speculative. I look at it and say, if you've done your homework and invest long term, I think the stock market's not speculative at all. Futures contracts are highly speculative because you have no idea in a short period of time which direction. You can guess, but no one has any idea for sure which direction things will really go. Yeah, and I agree, Brad. For most people, options contracts are going to have a lot more flexibility built into them. So in that way, I agree. Some people can accomplish futures contracts with less premium or less expense. So if I'm a farmer, and I have the difference between an option contract or a futures contract, I might do the futures contract just to save myself some money, right, in costs. And if I know I can deliver the product, then I'm okay with the fact that there's not an option, right? It's just a guarantee that I'm going to deliver the product. So anyway, something to consider there. But yeah, as far as just speculating, I would tell anybody who asked me, if I just want to speculate in a commodity, I would tell them then you should speculate with options, not with futures contracts, right? The only way I do futures contracts is if I was a producer or user of a particular commodity. Yeah, well, and Brad, the interesting thing is that there aren't any companies that have a perfect track record of predicting, right? There's no crystal ball. There's nobody who has an algorithm that tells them exactly which way things will go. If there wasn't risk associated with these, then you wouldn't have people on both sides of the equation. If you think about that for a minute, if we all knew, or if there was a real easy way of predicting which direction things would go, then no one would take the other part of the contract, right? We'd all be trying to buy one part of the contract, and nobody would enter into the contract with us on the other side. So for these farmers and for these miners and for airline companies, it's a really positive thing for them that we can't predict, right? Because if we could, then nobody would enter into the opposite arrangement with them and enter into the contract. That's right. There would be no reward, is actually what would happen, Brad. There would be no futures market. There would be no options market. There'd still be a stock market, and that's for other reasons, but there'd be no options or futures market if we could accurately predict direction of all these different commodities. Okay, so in a weird kind of way, farmers and the users of different products are actually, it's good news that it's unpredictable, because then they can hedge and create predictability from something that, you know, that we don't know for sure what will happen because of the fact that it's unpredictable. Okay? It's a little deeper than I expected to go, Brad. Good questions. All right, so you've got options versus futures. Main difference is you've got the right to buy an option, you know, an option contract, and you have the obligation to buy in a futures contract. Again, you can have significant potential loss on the future side. On the option side, you can limit it to what you put in, right? If I put $100 into an option, that's all I can lose with a certain, you know, certain kinds of options. With a futures market, I could potentially lose much more than what I put in. Back in 1848, the Chicago Board of Trade is the first place that created a futures exchange. You got hedgers and speculators. We already talked about that. Speculators, I think that's a really tall order to be a good speculator when it comes to commodities and not protect yourselves. As far as the people who are hedging, I think that's prudent. I think that's a great idea. All futures are traded on margin, remember, but we're not borrowing money until we get to the point that we have to execute on the contract. Here's major classes of commodities. We've got agriculture, livestock, energy, metals, food, and other. You can, as you can see here, you can buy futures contracts on freight, the environment, the weather, the market, real estate, lumber. I mean, just some very interesting categories there if you think about it. One of the things that you'll notice is missing from agriculture, for those of you who have any connection to the state of Idaho, you'll recognize the name of Simplot. Simplot is one of the largest producers of potatoes, and they also have a lot of different things, right, Brad? They do mining, they do fertilizer, it's a huge company, right? There you go, Cynthia. So you're probably familiar with the name Simplot. Years ago, if you look this up, if you're curious, Simplot tried to manipulate the pricing of potatoes so that they could make more money, so they could make more profit. Because of that manipulation, I think it was back in the 70s. You'd have to double check when you do your research if you're curious, right? But because of that manipulation, the major exchanges banned potatoes from the futures exchange, to the point where actually you cannot, as a potato farmer, buy futures in potatoes. So strangely enough, almost every other agricultural product is available, but potatoes are not, because of what happened back in the day when Simplot was trying to manipulate potato pricing. Okay? Kind of an interesting history lesson for the day, but also interesting that as a potato farmer, I'm not able to hedge like other, types of farmers can. So anyway, just thought you might want to know that. I'm also from Idaho, so it's kind of an interesting thing, and I was also familiar with Simplot, having lived there. Big company. All right, I think we're going to be done. You can buy currency futures, where you lock in the price of a currency in the future. Why would a company want to do this? So if we take speculators aside for a minute and say, okay, we're not talking about speculators, people trying to speculate on how much money they can make off another currency, but what about a company? Let's go back to our example of Apple. Apple sells iPhones all over the world, right? Almost every country has access to iPhones through Apple. Well, currencies in every one of the countries that Apple operates are volatile, right? They change all the time versus the dollar. Let's say Apple is selling a lot of iPhones in China, and they're concerned that the yuan is going to weaken. One of the things that they could do is, when they sell a lot of iPhones in China, they could actually hedge the price of the yuan okay, by buying futures in the yuan, okay, in the Chinese yuan. So that's a way for them to protect themselves from currency risk. If you ever talk about international business, one of the key things that's hard for international businesses to work with is currency, right? And how currencies change. Currencies can change so fast that a company can make a lot of profit in a country, and because of a currency change, they have to take a significant loss. A few years ago, a company in Utah called Nu Skin, it's a multi-level marketing company that does like supplements and beauty care products. They took almost $100 million, maybe it was even more than $100 million, like $100 million loss in Venezuela because they had significant operations there, but their currency changed so fast versus the dollar that they had to take a significant loss. And that's just the risk that you take doing international business, right? There's always a risk that by the time you can convert your currency back to dollars, okay, and bring them back to the U.S., they may have changed in value in the country that you're in to such an extent that you end up losing money. And especially in the case of a company like Apple, where they're keeping money overseas so that they can avoid paying taxes here in the United States, which hits the news quite a bit here in the U.S. People don't like that. Governments here is trying to find ways to get them to bring their money back to invest it here in the United States instead of keeping it overseas. Well, if I'm Apple, I have a team of analysts that are analyzing our risk exposure in these different countries that we're holding currency. We hold a lot of currency. If I'm, again, talking as if we're at Apple, if we're at a board meeting, we're going to say, okay, we hold, let's say, $2 or $3 billion in euros. If the euro goes down substantially versus the dollar, we're going to lose hundreds of millions of dollars. So what do? Well, we can pay through an exchange another party. We might have to pay them a few $1 million for this contract, but by spending a few $1 million, we protect ourselves against the euro going down at some point in the future and us losing hundreds of millions of dollars. So it's like insurance at that point, right? To try to keep the same price or a predictable price for a currency. All right, so we'll end on that. Any questions about futures trading, the reason that we do futures trading and hedging before we get to topics for the test? Okay. Pretty obscure topic, not something that you go around a water cooler and talk about. Everybody likes to talk about how their investments do. Not very often do people talk about futures contracts. If you were to go and apply at a company to work for a company that actually employed hedging strategies using futures contracts, and you could speak halfway intelligently with ownership or management about hedging strategies, it would go a very long way for you to getting that job or to getting a promotion within that company, because it's not widely known information, right? That a lot of companies use hedging strategies. And if you were familiar with those, not a deep understanding, but if you were just familiar with basic hedging strategies and the reasons for them, that'd be pretty impressive for me if I was a hiring manager. Okay? So I think it's, you might not ever use futures contracts yourself as far as an investment is concerned or a hedge, but a company you work for very well might. Or a company you work for very well should, right? To protect the pricing on something that they use or produce. Okay? All right. It is time for us to review the test. The topics for the test. I mentioned there are 38 questions, true, false, multiple choice, no writing, and it is comprehensive. So we're going from chapters 9 through 15, which is a lot of pages in the ebook. If it were me, I would not read chapters 9 through 15 cover to cover. What I would do is take some notes tonight on topics that you will need to know, and then go ahead and find those topics in the ebook and read up on those topics if you don't feel comfortable already about them. Okay? All right, when we get done, we can go back through and answer any questions that you have, or clarify any of the questions that you might have missed. So number one on the test, you need to know how we get to the real rate of interest. This is a repeat question from a previous test, and when we talk about the real rate of interest, we're talking about the nominal rate, which is, think of it in terms of like a gross rate when it comes to interest rates. When we're talking about interest rates, it's the all-in rate, is the nominal rate, and the real rate is a subset, okay, that takes out inflation. Okay, that takes out inflation. So if you know that, if you understand what the real rate of interest is, okay, then you will get number 1 right on the test. Number 2 on the test, municipal bonds. Do municipal bonds usually have a higher rate or a lower rate than U.S. government bonds? If you can answer that question, again, a repeat question, then you'll get number 2 right on the test. If you think about the fact that municipal bonds pay tax-free income, that might help you to logically determine which one should have higher rates. So government bonds pay taxable income, municipal bonds pay tax-free income. So municipal bonds can probably afford to pay less. That would stand to reason because people are getting them tax-free. Okay, I've just given you the answer and the logic behind it. If you understand that concept for number 2 on the test, you'll get that one right. Number 3 on the test. What is the concept of risk premium on a bond? Okay, what is the concept of risk premium on a bond? What is risk premium on a bond? If you know what that is, you'll get number 3 right on the test. Number 4 on the test. Number 4 on the test, you need to understand the correlation between, or the relationship, I should say, between ratings for bonds and what the yields are on bonds. Again, I think this is a repeat question from a prior week, but the point is you need to understand that the higher a company is rated or a government is rated, usually the lower the interest rate that they have to pay. Remember, the interest rate that they're paying is the cost of them borrowing money. And the higher they're rated, or the lower the likelihood of them defaulting or going out of business or going away entirely, the lower the interest they have to pay. If you're about to go out of business and have a very low rating, you're going to have to pay people a lot of money to let you borrow money from them, right? If we're thinking about giving money to Uncle Rico for him to go blow on some crazy dream that he's got, he's going to have to pay us a lot of interest in order for us to be willing to do that. But if Aunt Nancy comes to us and says she needs to borrow a small amount of money, she's got perfect credit, she always pays things back, she's very conservative, she's very reliable, she's very honest, then we're probably going to charge little or no interest to Aunt Nancy. When we wanted to charge a lot to Uncle Rico because he's not as responsible and he's got a crazy idea, right? The same is true for bonds. The exact same concept is true for banks, bonds, and investments when it comes to fixed income. And we talked about how fixed income bonds and debt are synonymous, right? Those 3 terms. When a bond or debt or fixed income gets a higher rating, they are able to charge less interest, and therefore they pay less interest when it comes to your return on your investment. Okay? So if you understand that, you'll get number 4 right on the test. Number 5 on the test, we want to understand how inflation and market interest rates are or are not correlated. So the question is, and what you need to understand before you get to the test is, are interest rates and inflation correlated? Is there any correlation or relationship between interest rates and inflation? I think that was a repeat question again. Number 6 on the test, you want to know the pros and cons of mutual fund investing. Okay, pros and cons of mutual fund investing. You'll want to know who normally for a mutual fund company serves as a custodian. Okay, who serves as the custodian on mutual funds? Number 8 on the test, you want to understand, this is a repeat question. This was a little bit of a tricky question. I tried to give you guys a heads up last week, but it was kind of a tricky question on the test. Basically, mutual fund companies have, as an open-end investment company, you have regulations associated with being called an investment company. Not everybody's called an investment company. You only are if you're meeting the regulations associated with investment companies here in the United States. If you meet those rules, okay, and regulations, there are, or I should say there is, a significant benefit. And it has to do with what the IRS does if you're following those regulations. So that's the clue I will give you. But make sure you understand what advantage from the IRS an investment company has if they're following the rules and regulations of an investment company. And it's a big deal. It's one of the main reasons why a lot of companies, investment firms, want to be investment companies or deemed investment companies, because the IRS is going to give them some kind of benefit if they follow the rules. So what benefit is that? That will give you the answer for number 8 on a repeat question from a previous week. Number 9, you want to understand what an open-end investment company is, basically a mutual fund company. But what is an open-end investment company? What does the book say an open-end investment company is? And be able to compare that for number 10 to what a closed-end fund is. So you've got open-end mutual fund companies and you've got closed-end mutual fund companies. What's the difference? What are the basic tenets of each? And you'll get 9 and 10 right on the test. Number 11 on the test, ask you, I think, another repeat question. What is a basic investment within a very conservative asset allocation? So you'll recall we had a slide where we had conservative, moderate, and aggressive investment allocations, and then it gave you examples of the percentages of each category of investment within those different allocations. For example, an aggressive asset allocation had more in domestic and international equities or stocks, right? A conservative asset allocation had more in short-term investments, bonds, and cash. If you understand that generally, you don't have to memorize every part of the asset allocation, but if you understand that generally, you know, as you become more conservative, you've got more short-term securities, bonds, and cash. As you become more aggressive, you've got more equities, you know, meaning more stocks, international stocks, those types of things. Then you'll get number 11 right on the test. Number 12 on the test goes back to a concept that we talked about, I think it was last week, where we talk about analyzing needs and objectives, trying to find the right kinds of investments for a client. What are the steps, right? What are the steps? Do we walk in? You know, if I want to start investing, do I just go onto Fidelity's website and invest in the first stock I see or the first mutual fund that has 5 stars and has a great return? The answer, of course, is no. You shouldn't invest that way. You should do your homework. We talked about this in terms of going to purchase a car, right? How we would do our homework. We would know what kind of car we wanted, what kind of car was good for us before we ever even got to a dealership, right? Or bought it online. We would do our homework first. Same is true for investing. Pretty straightforward, number 12, but just make sure you understand what the book has to say about that process of building your own asset allocation and investment. Number 13 talks about utility stocks. This is one that I got some questions on last week. What generally, okay, is the objective of investing in utility stocks? Let me just tell you, utility stocks generally are more conservative than most stocks. They generally pay higher income than most stocks. Okay, so now you've got the answer for number 13. That's a repeat question from a previous test, but it wasn't as straightforward. I don't think many of you had a hard time finding that material within the text. The text did allude to utility stocks being more conservative, but it didn't spell it out exactly the same way that this question does. So now you have it. An advantage or value add to paying attention during the session and taking some notes. You now have got number 13 right for sure, because you understand why utility stocks are used within an investment portfolio. They're looked at as more conservative and higher income paying. Number 14 on the test asks you, and this is a repeat question, whether or not in a good asset allocation you would have all the asset categories equally weighted. We talked about this whenever it was that we covered this, and it was on your test. I think it was last week. But equal weighting of categories and asset allocation are two very different things. Asset allocation is about getting the correct weighting based on how aggressive or how much risk you want to take, how conservative or aggressive you are. It has nothing to do with trying to be exactly equal on different asset categories. Okay? And you would understand that if you just read what the book has to say about asset allocation in general. Number 15 is a really straightforward, don't overthink it type question. It basically asks you if it's smart to make sure and consider the needs of an investor before creating a portfolio for that investor. Okay. Now, there's no reason to overthink this one. And it should be really, really easy, just as I say that, in your mind to know whether or not that concept is right or wrong. Should we evaluate a person's needs before creating a portfolio for them? Okay, you should be screaming. You should be screaming in your head what the right answer is to that question. Very straightforward, very easy. Number 16 on the test talks about stock options. What are stock options? What's the general idea about stock options? Number 17 on the test, what are rights? Okay, we talked about rights and warrants. What are rights? Number 18 on the test, a maker of a put or a call. And remember, we talked about how a maker is synonymous with a seller or a writer. When it comes to options, seller, writer, maker, those are all synonymous. Of a put or a call is X. What is it? What does it mean to have a writer of a put or a call, or a seller of a writer or a call, or a maker of a writer or call? What actually is happening there when it comes to options? Writers of option contracts are who and how do they profit? If you can answer that question, you'll get number 19 right. Again, you want to go back to the chapter on options if you're just totally confused by the whole concept of that we're discussing on options. Number 20 on the test is another repeat question. Which exchange, okay, which exchange are stock options traded on in the United States? Or maybe a better question, which exchange was first trading options? Because other exchanges have since started to trade options, but there is an original in the United States exchange that was trading options. Okay, then we talked about behavioral finance, right? We talked about representativeness, overconfidence, familiarity bias, loss aversion. These are some examples. If you know those four, know basically what they are, you'll get number 21 right on the test. Number 22 on the test, what is technical analysis? What is technical analysis? Why do we use technical analysis? Number 22. You need to know more than we just want to look at charts, right? The answer is there's more to why we use technical analysis than just we like charts, we think charts are fun, we want to make money because of charts. It's a little more than that. Make sure you know what the book has to say about why people use technical analysis, and you'll get number 22 right on the test. Number 23 on the test, flight to quality. You need to know what the concept flight to quality is. What does the book say flight to quality is? Okay, this is a concept, flight to quality. What is flight to quality? Okay. Number 24 on the test, what is bond duration? And this is a little bit of a trick question, so make sure and actually look up what bond duration is. Don't guess. Bond duration sounds like one thing, but it actually means something a little different. So this will be a trick question if you didn't look up the actual definition of bond duration. If you look it up, you'll be in great shape for the test number 24, but a little bit tricky if you didn't look it up, just thinking, oh, I probably know what that means, then you'll probably get it wrong. Okay, so make sure and look it up, make sure and understand what bond duration is before you get to the test. What is the mathematical link between a bond's price and interest rate change? What is the mathematical link between a bond's price and interest rate changes? What is that? Look it up in the chapter on bonds and you'll be in great shape. Number 26 on the test. What does it mean to take mortgages and bundle them and sell them? So what happened in the 2008 financial crisis here in the United States is that companies, primarily banks, were taking mortgages, bundling them, meaning packaging them, hundreds and hundreds and thousands of them, into a product and then selling that product to other banks, countries, or investors. The problem is those bundles of mortgages became kind of a black box situation where we didn't know exactly what was inside of them. But before you get to the test, make sure you understand what is it called when a company will bundle, something like mortgages and then sell them to somebody else. Okay, what is that? What is it called when you do that? Number 27 on the test, what is the mutual fund cash ratio? MFCR. What is the mutual fund cash ratio? If you understand what the mutual fund cash ratio is, you'll get number 27 on the test right. Number 28, what is a unit investment trust, or UIT? Commonly known as a UIT. What is a UIT? What does that stand for? What does it do? Why does it exist? You'll get number 28 right on the test. Number 29 on the test, risk-seeking investors should do what type of investment category? What types of mutual funds should risk-seeking investors do? So investors that are looking for risk, high return, high risk. What types of funds should they invest in? Okay, if you know that, you'll get number 29 right on the test. Number 30 on the test. Again, so straightforward. Do not overthink it. Number 30 on the test should just sound right or wrong. Okay, and if it sounds right, it's true. If it sounds wrong, it's false. It just has to do with what investors should or shouldn't do. Very straightforward. Even if you'd never read the book or any of the chapters, you don't overthink it. Just answer what you think is right when it comes to investing, and you'll probably get that one right for 30. Number 31 on the test. When we talk about return, we talk about total return, right? We talk about income plus gains or losses. And we refer to that as total income. So what about when it comes to options and futures? Okay. So when we invest in a stock or mutual fund, we have both income and we have capital gains or losses. When it comes to futures or options, it's a little bit different. So just make sure you understand what total return calculations what is involved in a total return calculation for a futures contract or an option. And that's different than like a stock or mutual fund where you have a total return calculation. Okay. Options and futures are different. How are they different than a regular investment when it comes to totaling up the total return? Okay, number 32 on the test, what are capital gains? What are capital gains? And when you're evaluating a portfolio, do you look at unrealized capital gains or realized capital gains, or both? So what does the book have to say about looking at a portfolio or mutual fund returns, whether or not you look at unrealized gains, the ones you haven't sold yet, or realized gains, the ones you have sold for profit? Or do you look at both? So make sure you understand what the book has to say about that on number 32 on the test. You'll get that right. Number 33 on the test. How do you calculate a dividend yield on a stock? How do you calculate the dividend yield of a stock? Pretty straightforward, but just understand how you calculate the dividend yield of a stock. If you didn't know the yield, how would you calculate it? What information would you use and how would you use it? It's a very straightforward calculation. Just two numbers are needed, two inputs, so it's nothing hard to memorize. Make a quick note of it before you get to the test and you'll be in great shape. Number 34 on the test. What is the time premium of a call option? How does it work? What is the time premium of a call option and how does it work? You'll get number 34 right. Number 35. Definition of a commodity. What is the definition of a commodity according to the book? Number 36, in commodities trading, what is open interest at the end of the trading day? What does it mean? What is the open interest at the end of the trading day in commodities trading? If you know what that is, basically, you'll get number 36 right on the test. Number 37, rate of return on a futures contract is based on what? The rate of return on a futures contract is based on what? Okay. Number 38, just know what the inputs are on calculating what your rate of return on a futures contract is, and you'll get number 37 right. Number 38, what's the difference between hedgers and speculators when it comes to the commodities market? We talked about it a little bit tonight, but make sure you understand the difference between hedgers and speculators as far as the book is concerned before you get to the test, and you'll get number 38 right. Okay. All right, that's all 38 questions. Any repeats or clarifications? that you need before we wrap up tonight? Okay, Cynthia, help me out. Which one can we help you on? And not 1 through 38. Okay. Just give me all 4 numbers and we'll get them all knocked out. $21, $25. Getting to $21. $21 is the behavioral finance question. You need to know the difference basically between representativeness, overconfidence, familiarity bias, and loss aversion. If you know those 4 concepts, what the definition of each of those are, then you'll be just fine on 21. You'll get that one right. Okay? We okay on 21? Okay. Representativeness, overconfidence, familiarity bias, and loss aversion. Representativeness, overconfidence, familiarity bias, and loss aversion. Okay? 25. What is the mathematical link? What is the mathematical link between a bond price and interest rate change? So you're looking for a definition that's defined as the mathematical link between a bond price and an interest rate change. Definition of commodity for 35. So when the book talks about commodities, this chapter, so chapter 15, it's commodities, what we're covering today. Then you want chapter 35, or excuse me, question 35, you want to know the definition of commodity according to the book. Number 37, what determines the total return or rate of return on a futures contract? What determines the rate of return on a futures contract? And the trick here is not just the underlying product, but also something else about that contract will, well, a couple other things about that contract will determine your total return, okay? So just make sure you understand how to get to the total return on a futures contract. What determines how much you're going to make on a futures contract, okay? Was there a correct answer to Luke's quandary? The answer is yes, there should have been a correct answer to that. And I'm not going to give you one way or the other. If you would have justified Brad either way, saying yes or no to whether or not he should hedge, if you did a great job explaining why you think that is, and it's evident to me that you understand hedging and options trading, then I don't care which answer you gave as long as you did a good job of explaining it. I'm still going to give you full credit. But if you give me very little detail about why, and it's not the right, not really the right direction that it should have gone, then you'll lose some points, okay? So I just need to understand that you kind of efforted the understanding why somebody would hedge or use options or not, and understood a little bit of the math, right? Because leading up to that final question, there was some math associated with it, and if the math was in his favor, then he probably should have done it, right? So sometimes it was up to the, whether or not you got the math right on the previous parts. And his feelings, right? His perspective, his opinion definitely matters on that. But that's why I say, I mean, it's did you read it right? Did you do the math right? And then can you justify how you answered it? I agree. Okay, so number 20 on the test was which of the exchanges in the United States was the first one to do stock options? Where were stock options first traded on an exchange in the United States? Okay. All right, should we wrap it up? Yes, we did. We looked at the page that it had it on it, right, Cynthia? But it also says it in both chapters, both the options chapter and the futures chapter refer to this exchange that you need to know for the test. 19. Brad, we can't go backwards all the way back to 1 from 20. I'm just giving you a hard time, man. Writers of options contracts, who are they? Who are the writers of options contracts? Remember, we talked about writer, seller, maker. Those are all synonymous. Those all mean the same thing when it comes to options. Who are they? What are they doing? If you understand that, you'll be in great shape for number 19. Okay? All right. Well, good luck to both of you. Make sure and be in touch with me if there's anything I can do for you. Call, text, email, whatever's good. Good luck this week with the test. It's going to be, I think people are going to do about as well as they study and prepare for it. I gave you probably 5 or 6 answers within the information I gave you when we were reviewing the test material. And so that would really help if you just listen a little bit to what we were talking about tonight during the final review. So I'm encouraged by the fact that you'll get a good score. You'll have some repeat questions from previous weeks, and you'll have some answers that I gave you while I was going over the different topics. So I feel like you'll be in great shape as long as you do just a little bit of study about those topics. Okay? And in the meantime, if you have anything that I can help with, let me know. Please, please, please get all your work done. No reason, like I said, to fail a class like this because you missed an assignment or two or didn't complete a discussion board. That's just silly. Put in the time and effort necessary, get your work in so we can get past this class and get on to the next thing, right? Keep progressing. Best of luck to all of you. Again, shout out to anybody down in Texas. I just hope the best for you, and I'm sure the school will work with you if you've been displaced or if there's any significant issue, to be able to retake this class at a later time. I just hope that you're safe, though. So, well, Brad, keep in touch, man. I'd be happy to try to give you some feedback on how to, enter the industry, what to do in the industry. But I will tell you that there are some more classes, some more finance classes that you'll be taking for your degree that will introduce you to some better concepts. This class wasn't really highly focused on kind of the financial advisory side as much as it was just some products and some different aspects of investments, right? So there will be some more stuff that you'll get to do, Brad, to go from there. Okay, have a good evening. Cynthia, good luck with the next finance class. Good night.